Hey everyone, and welcome back to the channel. If you're an investor, you know that earnings season is like report card day for companies, and one of the most watched reports this season came from telecom giant Verizon. Their Q3 2025 earnings, released on October 29th, tell a story of two very different halves: solid profitability and a confident new strategy, but also some persistent challenges. So, what's the real verdict? Let's break it down. Verizon Communications, Inc. is a leading American multinational telecommunications conglomerate and a foundational component of the Dow Jones Industrial Average. The company's core business revolves around providing wireless services to a massive consumer and enterprise customer base through its nation-leading 5G and 4G LTE network. Beyond mobility, Verizon is a major player in the broadband and fiber optics sector, delivering Fios internet, television, and digital phone services to residential and business customers. It also offers a comprehensive suite of solutions for government and corporate clients, including secure networking, cloud infrastructure, IoT, Internet of Things, connectivity, and advanced security services. Ultimately, Verizon's overarching corporate strategy is centered on building, operating, and monetizing next-generation network platforms to drive connectivity and digital transformation across the United States. First, the headline numbers. Verizon reported revenue of $33.8 billion. That's up 1.5% from last year, but it was a slight miss against analyst estimates, which were hovering around $34.2 to $34.3 billion. However, where it really counted for investors, Verizon delivered. Adjusted EPS came in at $1.21, beating the forecast of $1.19. And in a really strong showing, net income skyrocketed to $5.1 billion, a massive 50% increase from the $3.4 billion they reported in Q3 of last year.
So, the bottom line? Strong. The top line? A little soft. Diving into the core business, Verizon's crown jewel remains its wireless service revenue, which grew 2.1% to $21 billion, maintaining its position as the industry leader. But here's the figure that raised some eyebrows. The consumer segment actually lost 7,000 wireless postpaid phone customers. This was a miss, as analysts were expecting a gain. It shows that competitive pressures in the consumer wireless space are as fierce as ever. The bright spot offsetting this? Broadband. Verizon added a very healthy 306,000 broadband customers, proving that their fixed wireless and Fios strategy is a major growth engine, with total connections now over 13.2 million. On the business side, revenue was down 2.8%, though they did manage to add 51,000 postpaid phone connections. Now, the single biggest story from this earnings call wasn't just a number, it was a person. This was the first earnings call under new CEO Dan Schulman. And his message was clear. This isn't about incremental changes. Schulman is promising an aggressive transformation of Verizon's culture, cost structure, and financial profile. He's focusing on customer centricity, investing in AI and digital experiences, and implementing smarter cost controls. The market reacted positively to this vision, with shares rising after the report. Analysts see this as a crucial and necessary pivot for the company's long-term health. So, what's the bottom line for investors? Let's look at the pillars of a solid income stock. Profitability and cash flow. Check. EPS beat, net income surged, and free cash flow is up significantly to $15.8 billion for the first 9 months. Dividend reliability? A big check. Verizon raised its dividend for the 19th consecutive year. For income investors, that's a powerful signal of stability. Future guidance. Confident. The company reaffirmed its full-year 2025 outlook, expecting wireless service revenue growth and adjusted EPS growth to continue. The challenges remain: top-line revenue growth and subscriber volatility in a cutthroat market. But under its new CEO, Verizon is signaling that it's not just playing defense, it's undertaking a strategic overhaul to drive sustainable shareholder returns.
Let's look at the reasons an investor might be bullish on Verizon. First and foremost, the dividend. With a forward yield hovering around a massive 6.3%, Verizon is a powerhouse for income. This isn't a shaky dividend either. Analysts highlight that it's well covered by the company's strong free cash flow, making it a cornerstone for income-focused portfolios. Second, there's the growth engine of 5G and broadband. Verizon has been aggressively investing in its 5G ultra-wideband network and expanding its fiber footprint, notably through the acquisition of Frontier's assets. This positions them for long-term growth in both the consumer mobile space and the critical fixed wireless and enterprise segments. Third, we have a new strategic vision. Under new CEO Dan Schulman, Verizon is undergoing a customer-centric overhaul. The focus is on operational efficiency, improving the digital experience, and strict cost discipline. If successful, this transformation could unlock significant shareholder value over time. And finally, the valuation. Compared to its peers, Verizon looks cheap. It's trading at a low P/E ratio of around 8.6x, which suggests the stock might be undervalued based on traditional metrics. For value investors, this is a very attractive entry point. Now, let's flip the coin and look at the very real challenges Verizon is facing. This is where the story gets complicated. The biggest headwind is intense competition. The wireless war with T-Mobile and AT&T is brutal. These rivals are aggressively cutting prices and innovating, making it incredibly difficult for Verizon to grow its subscriber base and protect its profit margins. Then there's the elephant in the room: debt. Verizon is carrying a staggering over $119 billion in unsecured debt. This heavy load limits their financial flexibility and makes them highly vulnerable to interest rate hikes or an economic downturn. This competitive pressure is already showing in their subscriber numbers. The company has been losing valuable post-paid phone customers in its core consumer segment. Even business revenue is under pressure, highlighting a real need for better retention and acquisition strategies. And finally, with growth comes integration risk. That promising Frontier acquisition for fiber expansion? It also brings the challenge of merging operations and significant capital expenditure demands, which could strain resources if not executed perfectly.
Now let's talk about the dividends. Verizon isn't some newcomer trying to win you over with a flashy payout. This is a dividend aristocrat in all but name. The company has raised its dividend for 19 consecutive years. Think about that. Through recessions, tech bubbles, and a global pandemic, Verizon has consistently given its shareholders a raise. In fact, if you include its history as Bell Atlantic, we're looking at over 42 years of uninterrupted dividend payments. That's a level of commitment that commands respect. In 2025, they increased the quarterly payout to 69 cents per share, a modest but meaningful bump that signals continued confidence. Okay, a long history is great, but we need to know if it's sustainable. This is where the story gets interesting. If you just look at the payout ratio, which is near 101%, you might panic. That means they're paying out roughly what they earn. However, for a telecom giant like Verizon, we need to look deeper, at cash flow. And here's the magic number. In just the first 9 months of 2025, Verizon generated a massive $15.8 billion in free cash flow. This is the cash left over after funding the business, and it's the true source of dividend payments. That $15.8 billion comfortably covers all their dividend obligations. This is why analysts, despite the high payout ratio, overwhelmingly view this dividend as secure. It's not being paid from debt, it's being paid from a gusher of operational cash flow. So, what's backing this cash flow? It's Verizon's core business. Even in a competitive market, they are a cash flow machine. Their strategic transformation efforts and financial discipline under the new CEO are squarely focused on sustaining this strength. This consistent generation of excess free cash flow means they not only can maintain the dividend, but also have the capacity for future increases or even share buybacks. This isn't a company on the edge, it's a company managing a mature, highly cash-generative business. So, let's bring it all together. Is Verizon's dividend safe? The evidence points to a strong yes. Here's the bottom line for investors. You're getting a high 6.3% yield. It's backed by one of the most reliable cash flows in corporate America. It's supported by a 19-year track record of increases and a clear commitment from management.
While the dividend growth has been modest, around 2.3% annually, this stock isn't for hypergrowth seekers. It's a foundational, income-generating rock for a portfolio. If you're looking for a safe and consistent dividend pair, Verizon, with its monster yield, deserves a very close look. The consensus on Verizon is best described as moderate buy, or even a hold. It's not setting the world on fire with excitement, but it's not being written off either. Here's what that looks like in numbers. Out of about 24 analysts, only about 20 to 25% are giving it a strong buy. The vast majority, around 50 to 55%, are saying hold, and the number of analysts yelling sell is very, very low. So the overall mood is cautious, but leaning slightly positive. The average analyst price target sits between $46.50 and $49.50. With Verizon's current price hovering around $40, that implies a potential upside of 15 to 24% from here. That's not a moonshot, but it's a very respectable return, especially when you add that juicy dividend on top. Analysts see Verizon as a defensive play with income and value characteristics. It's not for the growth-focused investor looking for explosive returns. But if you're looking for stability, a very safe and high dividend, and moderate appreciation potential while you wait for the company's transformation to bear fruit, then Verizon is a solid, moderate buy or hold. It's a stock you buy for safety and income, not for a quick double. What's your thesis on Verizon? Is it a core part of your income portfolio, or are you staying away because of the growth concerns? Let me know in the comments below.